Everybody hear me okay? Okay. First, thank you very much for having me today, and I'm going to go ahead and apologize. I'm really one of these bad allergy sufferers, so I'm on enough allergy medication that I stay parched all the time during this year. So if I take a frequent drink of water, I apologize for that. Does sound like you got some very good speakers coming up. The alcohol industry, for my membership, is always something very much of note, and I've got to spend a lot of time with Treasurer Falwell through the years. I worked on the workers' compensation reform with him and had the fun of sitting in a conference room with him for 13 hours. Straight negotiating that with the trial lawyer. So although he kept feeding us bags of carrots that he kept, I'm surprised I didn't turn orange after 13 hours. With that, I'll sort of go through this border adjustment tax and try and see. Donna set my bar pretty high that I'm pretty good at explaining complicated things. We'll see it by the end, but I appreciate you being here and appreciate you having me today. So this is real quick on our organization, the North Carolina Retail Merchants Association. We also manage the South Carolina Retail Association since 2004. Our association's been around since 1902, so 115 years old. We're celebrating our anniversary. I was not there when we started, but I am the fifth president that we've had. We work nonstop. I've got a lobbying team of ourselves, myself and two other people in North Carolina and one in South Carolina. We work very close with the Locke Foundation on a number of issues. These are just a couple of the things we've worked on in the past. Some of them are of issues to you guys. Things like we banned contingency fee auditors. We repealed the local privilege license tax, which was costing retailers $62 million here in North Carolina. If you've done a beer and wine tasting, I know that's alcohol next week. We helped write that law, the growler law, a lot of the labor mandates we work on, especially with the Locke Foundation. So I don't like to play in the sandbox most of the time of Congress. And part of the reason is it's not my sandbox. But I think there's this overinflated thing sometimes that Congress is where everything happens. So 352 bills passed. In the 50 states plus DC, you had 45,000 bills passed, which is why we have such a focus on the local level. There's not the gridlock. Here in North Carolina alone, 604 bills passed, or 28%, which is why that we focus most of our time as an association on the state level. I think that gridlock is probably what it was when I was in DC last Monday for a little bit. So let's get to the border adjustment tax real quick and sort of talk about it. These are really, I'm going to give you an overview and then we're going to go sort of more into the weeds. So it's one of the key pillars of the House GOP tax plan from House and Ways Chairman Kevin Brady from Texas and House Speaker Paul Ryan from Wisconsin. So basically would exempt exports from being taxed while taxing imports. You sort of see what it does, and we're going to get back to what it means to you in a minute. This sounds pretty simple until you sort of start to get into the weeds of this. So I'm working with a group of more than 30 industry groups, would take advantage of this corporate tax cut. General rule of thumb, anytime someone tells you they're going to raise $1 trillion in revenue without asking anyone to pay for it, you should be skeptical. So the House tax plan, that's their theory. We're going to reduce and do tax reform and save $1 trillion, but in order to do that, there's something called pay for. You have to figure out a way to offset that. And then we're going to circle back in a minute to what Donna said about North Carolina's tax reform and how that works too. So let's start with this. Let's start with these items. An avocado, coffee, gasoline, car, and banana. I was involved with, I think, 4 of the 5 this morning. I did have some coffee for breakfast, probably too much. Did have some gas in my car, stopped this morning, rode my car, and did have a banana for breakfast because my wife is on me to eat a little healthier. Didn't have any avocado today. So we're going to get back to these in a minute, what all these items have in common. But let's start with what the border adjustment tax is not. It's not a wall. It's not to build the wall, but we hear border, we hear adjustment, and we think the wall. It's not about that. So again, these are the authors of this, 2 very, very smart folks in the theoretical sense, Speaker Paul Ryan and Congressman Kevin Brady, who have come forth again with this program. So why is it being discussed? It's called the pay for. It means that if you're going to reduce tax rates or spend more money, you have to pay for these items with revenue to offset the tax reduction or expenditure of money. So if you think about, in some instances, I think this is really good. If you're going to spend money, you ought to have to offset it. But Donna referenced the tax reform in North Carolina. We probably would have never had that if we would have had to do a pay for. If you think about the Reagan tax cuts, if he'd had to do pay for, it would have never happened. In the 20s, the go-go 20s, it would have never happened. The 60s, when we sort of stabilized ourselves, would have never happened if not for the pay, if we would have had pay for it at the time. But this is the rule of the U.S. Congress. So what is it paying for? The United States has one of the highest corporate income tax rates in the industrialized world of 35% of income. As a comparison, in North Carolina, we're at 3% right now. So they've proposed the BAT to raise $1 trillion to lower the corporate income tax from 35% to 20%, or President Trump would like to go to 15% and make the United States more competitive. It's why you hear about trillions and trillions of dollars being housed offshore. It discourages companies from moving overseas in search of lower tax rates and selling products back to the United States. Has anybody heard of what an inversion is? Does anybody know that? Where you're a company in the United States, but because of the high corporate tax rates, you merge with a company overseas, even if it's a smaller company, so that you can take advantage of their tax rates. Their hope was that if you did this, that you would minimize that, and you would have more investment here in the United States. All very laudable goals. I think anybody can see, especially in North Carolina, with what has happened by lowering our corporate tax rate, that has helped generate jobs. We're one of 3 states or 4 states that have a surplus right now due to the tax reform we've done here in North Carolina. So very, very laudable. And again, I think we're going to come back to the $1 trillion and how we got there. So let's look at why this matters. So you sort of need to dive into how does the corporate tax rate work. So let's say Company X has $1 million in revenue. So Company X can deduct both the cost of the goods sold, whether they produced or purchased for resale. So the widget that you buy, you can deduct that off what your sales were for the year. You can also deduct general administrative expenses like wages, advertising, interest expense, depreciation, to get to a net profit. So after you do that, they apply the 35% tax rate for the United States and the 3% for North Carolina. So let's look at a company like this, which is, again, $1 million in revenue. Let's say it spent $400,000 producing the inventory that was sold during the year. It can deduct that $400,000 of the cost of goods sold from its $1 million of revenue. And then let's say they had $200,000 of wages, interest, depreciation, advertising, reducing it to a total of $400,000. So we got $600,000 of expenses that are deductible off the $1 million of revenue. At that point, you'd apply the 35% corporate income tax rate, and it would leave them with a tax bill of $140,000 to pay over to Uncle Sam. Does that make sense so far? Okay. So here's what we're going to do with the border adjustment tax. We're going to eliminate from income revenue generated through exports. And we're going to eliminate the 20% deduction for the cost of the goods if they're imported. So here's the result of this. All the revenues that you get from exports will be tax exempt for the exporters. So they do not count as part of your revenues, not even reportable on their tax return. All imports would not be deductible for tax purposes to the business doing the importing. So all those goods that you deduct in, again, we're going to come back to that avocado, all those goods that you're paying the cost of, you don't get to deduct them. And the exporting companies basically would pay no corporate taxes. So if all you do is export out, you're basically going to have no sales. Or if you export a portion of it, you're going to subtract those sales off what your total sales are, your total revenue. But importing companies would have to report all of their revenues as profit and pay the full new corporate tax rate of 15 to 20% on the rates. Let's see if I get this. Okay, so it sounds simple in a textbook, and again, Speaker Ryan and Brady both come from an academic world. It sounds really good. But you have things like tourism, regular imports of people, complicated business structures where goods cross the borders multiple times. You may make a component in one country. It may come to the United States to do the second part. It may go back out somewhere else and then come back, which sometimes happens in things like car, technology, electronics, those sort of things. It doesn't take into account things like royalty or interest income, things like that. So let's go back and look at Company X that we talked about a minute ago. So let's say Company X had $600,000 of its revenue from overseas and made all of its products sold here in the United States. Okay? So that $1 million, $600,000 was sold that they exported. Company X would only have to claim the $400,000 in revenue made from sales in the United States and would have $600,000 in expenses, meaning Company X would now have a loss of $200,000. and they get a refund. So they had the same amount of sales as they do today, but because 600,000 of their sales were overseas, and all their goods were produced here in the United States, they have a loss and they get a refund. So let's say company Y, let's move and change a different company, also had revenue of $1 million, but all of its goods were sold in the United States and all of its goods were imported. Let's say I'm we'll go back to the avocado. I'm an importer of avocados, okay? So I can deduct the $200,000 in wages we talked a little bit ago, but I can't deduct the $400,000 of the avocados I bought. So now I have a net income of $800,000 that I'm going to have to pay the income tax of either 20% or 15% on. So again, let's go back to this. And there's millions of products that you could look at in the world right now. Avocados, again, we can't move the equator. They don't grow here in the United States except in California. You're going to pay more already this year for avocados because California had a very bad avocado season the last 2 years. Rain, they've had bad weather for growing avocados. So even before this, they were going up in price. But generally, that's something that you import. Coffee. They don't grow that in Black Mountain or Eden or even in California or Texas. So we import all of that coffee. Starbucks just went up. Gasoline. Most of our gasoline comes from where? Overseas, which makes us more foreign oil dependent potentially. Again, they're saying, that's probably a $30 billion increase easy there. It goes up 20%. Cars. We like to look at South Carolina and Alabama and some of these states that have car manufacturing facilities, and they do make the car there in the United States. But the parts, a lot of them, as you say, come from somewhere else. They're a component. So you may get this part, may come from, I think about the one, you may get it locally for the spark plug, but you may get the catalytic converter from somewhere else. So again, that increases the cost of that vehicle for everybody. Bananas. Again, I had one of those this morning. They don't really grow here very well in North Carolina, South Carolina, or anywhere in the United States. Again, you can't move the equator on a lot of the things that we use. My kids, for instance, they love to eat strawberries year-round, and I encourage that because it's good for them, but we only grow those sort of in a very short window of time. And this is what the American public sort of wants at this point in time. So let's look at this. I sort of use this as a pair of pants analogy. Let's say I get a pair of pants that are imported from Taiwan and they cost $10, and I sell the pants for $20. Before I factor in the goods, the rent, the wages, utility, I've got a gross profit of about $10. And after that, let's say when you add it all up, I've got $5 net profit. Now with that, I can't take the deduction for the cost of the pants. So I still have to pay these rent, wages, utilities, etc. But those are my fixed costs. I really can't change what my rent is. I can't change from Duke Energy what my electricity is. So I've got to increase the cost of the pants to the customer from maybe $20 to $30 to have the same net profit of $5. Now what Paul Ryan will tell you, what Kevin Brady will tell you is, yes, but the value of our dollar is going to go up 25% because we're doing all this foreign trade, these exports. I think in time it's going to take for it to go up that amount is a long, long time. And again, this is real because it's a deduction on your taxes. The value of the dollar going up is very much theoretical. You hope it goes up. Everybody hopes the value of the dollar goes up. Although when the value of the dollar goes up, it's harder to export, which sort of is counterintuitive to the whole theory. So here's the end result. Many necessities. Let's think about food. We talked about a lot of different kinds of food today. Everybody likes to eat, new ethnic food, whether it's sushi, whether it's Asian, whether it's Indian. That's sort of one of the things to do. Mexican, those things all go up. Clothing. I imagine if you pull the tag around and look and see what you got, it's probably made somewhere else, a lot of it, although a lot of it is coming back on shore, and we like to see that. Prescription drugs. I mentioned Glaxo a minute ago. A lot of those are made. Teva is the largest generic company in the world. They're based out of India, if I remember correctly. Gasoline, which we talked about. So that would cost consumers, again, for the pay for, because we got to get to that money to lower the corporate rate, $1 trillion over 10 years. So let that sink in for a minute as we go. The end result, based on Art Lafler, everybody knows Lafler is the very conservative economist. I think his numbers potentially showed 42 million jobs lost, disproportionate negative impact on U.S. retailers who employ about 1 in 4 people. But not only does it affect the retailers, because see, a lot of them are forced to close because the tax would far exceed the cost American consumers can pay. But let's think about Main Street in a town, and we'll pick a town, Laurinburg, which already has a pretty bad Main Street as it is right now, just because of their economics. If you start to shut down more of those businesses, you have more dark stores, more dark storefronts, less property tax, less income tax, less sales tax, all those things. It's bad for those communities as a whole. The mall, same thing, bad for the mall as a whole because you got less folks coming to shop. Maybe who it helps? It may help Alibaba. If you're going online to shop there, that's one of the areas where nobody's really been able to figure out. So here's what the big figure that I always sort of like to point to is a 20% tax hike, which is basically what it is. The average family would cost them $1,700 more a year. That's for every family in America, average family, $1,700 a year. Let's just say you took this off and said, if you went to every family and said, do you have $1,700 more dollars to pay for those pants, for those bananas, for those things? Most would tell you no. I think I saw the stat the other day. Very, very few people have, if they had a $400 emergency, they would know where to go to pay for their emergency. So let's add $1,700 there. So what do the polls say? A couple things. This was a poll that was done April the 2nd through the 5th. Strong majority of the voters oppose the border adjustment tax. 46% of the voters who strongly oppose it. Majority of the opposed to the proposal were voters in states with competitive U.S. Senate races, presidential races. There's some other issues that are out there with this too. The more people learn about this, which is one of the reasons that Don, I think, brought me over here, the more people learn about this, the more they say, is this really the right way to go? Because you're basing this theoretically on, again, the value of the dollar increasing by 20 to 25%. That's what you hope. That's what holds you out. But again, somewhat counterintuitive because then exports go down. You also have some additional issues that are out there floating around, whether it's constitutional, the 16th Amendment about apportioning of corporate income tax, whether that's meets that 16th Amendment test. What does another country do? Let's say the country that we were importing avocados and bananas from, or that we were importing oil from. If we put this out there, do they in turn say, well, we'll do our own border adjustment tax? We export a lot of things out of here. If you think about all the, let's say, pork that we export out of here in North Carolina, or all the tobacco that we export out of here in North Carolina, what happens to those countries that we're exporting to if we're treating their goods differently and giving a leg up on that? I mean, as much as we don't like it at times, we're very much a global economy. It's why my kids get to eat strawberries every day if they want to. So you have those issues hanging out there. Again, if you look at the retail person out there, they've got to make a decision on how to make up for the value of the cost of not being able to write off that good, which has been sort of a stalwart as an expense that you've been able to deduct since the beginning of the corporate income tax. If I'm in business, I get to deduct the cost of making that good or the cost of buying that good that I'm reselling. Back to your cable that we talked about earlier, when Bruce and I were talking about his business, when he was buying cable, he got to deduct the cost of the cable to get his net income to apply the corporate income tax. And in this case, you're not letting people do it, but others, you're going to say, you're not going to pay any tax at all. Or you may get a refund.
And loan it back to the company originally, and then they can go bankrupt.
Right. Well, or let me give you another thing. What's the thing that we all want to have happen, right? Because let's put this aside. We think about the trillions of dollars that we hear are offshore and nobody wants to bring it in because of how much it costs. So let's say you have a factory in Mexico. Let's say you have a factory in Korea, whatever it may be. When you bring that back over here, that's a cost of goods. That's a cost. You just disincentivized me from bringing that equipment, that manufacturing. Let's say I want to make those pair of pants, and I want to bring all my equipment back from that area. From those countries into the United States. I bring it across the board from Mexico into Texas. I just paid tax on it. I didn't get a deduction for it. I didn't get to depreciate it. And so you sort of disincentivize what we really, I think, want to do. You want to, I mean, I think you're seeing in some instances, a lot of businesses say it's a lot cheaper right now if I can have it manufactured here in America. I don't have to ship it, I don't have to do anything else, I don't have to worry about a port strike. If I can do that, you're starting to see some of that move back on shore. So this somewhat disincentivizes that going forward. You know, again, if you look at some of the very conservative economists, they've got issues with this. You know, they're moving along towards tax reform, and tax reform sounds great if it's done in the right way. But you've already had people like Warren Hatch, who's the chairman of the Senate Finance Committee, say, I don't know about this. You know, this is not going to be good. And you've already seen Ryan and Brady sort of move to, they call it now a half bat. We'll do 50% and 50%, you know, already sort of trying to figure that part out. A lot of it, again, goes back to the pay for. And again, I go back to North Carolina. You know, North Carolina did sort of a cutting of spending to be able to reduce it. They did do some offsetting and moving more to a consumption base, but it was not a pay for. You know, when they've cut the taxes to try and grow the economy, put more money in your pocket, that's sort of what it was about. So, questions on this? Yes, ma'am.
They already have them, so I mean that wouldn't be anything new.
Well, there's a sort of a different version of it, if I understand it correctly. Theirs is a VAT, a value-added tax. But it is my understanding it pretty much applies to all goods, and it's more of a sales tax more than it is the deduction on the cost of the goods. It's in a different, again, and you're not giving the company the ability to not count any of its sales for an export on their corporate income tax in that. So it's a little bit different, and I can get you some more information on it, but when you look at it, I was reading a paper by Lafleur over the weekend about this in preparation for this, and he distinguishes between those two of what some of the other countries do as the VAT, which is more like a gross receipts type tax, like a Texas and Ohio have, as opposed to this sort of mechanism where you're increasing the cost of the goods themselves to be in the business. Yes, sir.
Aren't they also trying to increase the amount of business that would be given to companies in the United States rather than buying stuff abroad?
They are. And again, I think, theoretically, I think we all think we want to have the most jobs we can have in the United States, the best paying jobs, the manufacturing jobs. We want all that. And I don't disagree with on it. Well, you want, well, that, well, you know, listen. Well, and I go back to, you know, my family's not allowed to buy Amazon. We don't allow it in my house, period. They're competing with the people that I do business, that I represent. We don't do it. It's the cheapest thing. You know, it's the same reason that people go, well, I don't know if it is either, but people perceive it to be. It's the same reason people go shopping at 4 grocery stores on a Sunday. You know, they're looking for the best deal. And that's sort of it's almost a mentality that we had from the Great Depression, and it came from the 2008 recession of I've got to get everything as cheap as I can get it. People want things that are inexpensive. You know, would you buy the strawberries if they were $5 a carton instead of $2 a carton or $3 a carton? I don't. You know, we want to produce, but some of the things again you can't produce. You know, again, we're not going to produce coffee here. Some of it's a technology thing, but yeah, I think at the end of the day, we would all like to have more manufacturing, better jobs here, and export everything. Problem is, if you do that, again, the value of the dollar, what happens overseas? Yes, sir.
I know the headline rate's 35% for corporate taxes, but what is it really after all the deductions such as research and development and all this other stuff, which is some people pay very low.
Right. I mean, I think I saw the other day, you know, that there's an effect, and we call it a corporate tax rate and an effective rate, you know, and I've said here in North Carolina, the corporate tax rate's about 3%. The effective rate's probably in the 1.5% by the time you get done for a company. By the time they have a loss or a carry forward or a tax credit or whatever it may be. U.S., I've seen anywhere that it's probably in the 22% range. You know, again, you have some that are much lower. But you have some that are, I heard the average is approximately 22. I mean, that's just one of the studies I've seen. You know, let me say this, because on the other side of it, back to your point, you have the people that are very much in support of this, or a company like Boeing is very much in support of this. Now, they manufacture in South Carolina and send everything pretty much overseas, a lot of the planes. GE, which is one I think you referenced earlier, or somebody referenced, I don't think they paid any corporate income tax last year. I don't know what the 15% really gets them, except maybe lower and a bigger refund. You pretty much a behemoth going forward. But those are the major two companies that have sort of been out there saying, we want the bat. So, yes, sir.
That $1 billion you quoted before, is that over a 10-year period or per annum?
My understanding it's over a 10-year period, and so is the corporate tax reduction. It's over a 10-year period of time.
And the gentleman made a comparison, he's talking per annum, $1 billion borrowing.
Yeah. Yes, sir.
So,
Yeah. Yes, sir. And
secondly, I also point out that we have before elections, because of the petroleum. And probably whether the oil line going up will probably be down. And the price of oil increased, we may be driving down our imports. Now, looking for out of them, my father is probably frowned upon that, because he's more of a libertarian, but
Way more.
way more. Yeah, I will say, and I can get you a sheet. There's a number of I've got a quote sheet on gasoline. A number of them that have looked at this and believe, just based on the current mix of what we get and where we get it, that you would see a dramatic increase in the price of gasoline, which not only affects gasoline, but the other products that it's used to manufacture with petroleum.
okay, I read the IER today.
Okay.
Institute for Energy Research.
Yeah. Yes, sir.
You mentioned VAT tax, and we know it's done in other countries. Has that tax hurt the United States exports? I know they're out there, but I don't,
Yeah, I'll be honest, and you may have one of the other economists that can speak. I don't know how much it's hurt or helped one way or the other. I really don't know, and I apologize.
I have neighbors who tell me we should put a toll at the Virginia-North Carolina border so we can, and we wind up eating our own when you get into this stuff.
Well, and if you look at, there is one, if you come into the Outer Banks from Newport News, they did put a toll there. But I think it was state of Virginia.
95.
Right, yeah. It's I was against the 95 toll. Yes, sir.
It looks like it's a radical change because previously they taxed product.
Yes.
It's no longer product that's being taxed.
Correct. That is actually had that on had that in my notes. You're exactly correct. You're not taxing net income, or net profit. You're taxing gross.
And I had a question you have in mind income, interest income. How would that be affected?
Interest income is folded up in this. Is my understanding would still be deductible, but I don't know how that plays if you're borrowing the money or if you're borrowing the money to buy the item. I'm not positive on that. Yes, sir, Bruce? Did you?
It almost looks to me like this is using tax policy to encourage companies to buy American. Or has the U.S. or any of the states, for that matter, and to your knowledge, used tax policy to punish companies or
I don't know
previously?
I don't know that we use it to punish. I mean, I think some of the proposals that you see, for instance, in North Carolina, we did a few years ago the single sales factor for corporate income tax as a way to get more manufacturing companies to locate here in North Carolina. Using the sales factor as your only one, not payroll and not not property. A number of states have done that. Right now, there's a proposal that would look at what's called market-based sourcing in North Carolina on corporate income tax of where do you get your services from in the state of North Carolina to do the same thing, to encourage companies to locate at headquarters here. So every state sort of does that, tries to figure out whether it's your tax rate, whether it's how you apportion it. They try to do that, but I don't know that they do it in a punishment factor. It's more of an enticement factor to get companies to invest here in the state. Yes, sir?
My comment is kind of just reiterating past view that have been made, not reiterating anyway, and that is the general notion of an income tax that it's a revenue-producing mechanism, and it's based upon the income is supposed to be something like a proxy of the taxpayer's ability to pay.
Right.
And that's what you were getting at when you said, so we just tax the profits. That's the proxy of your ability to pay. And that ability is the same whether the source of the income is from overseas or domestic.
Right.
The ability to pay doesn't change. And so then what has happened is because of what we used to call industrial policy, I guess, this kind of mentality of the border adjustment tax is not really focused on revenue reduction, but on favoring certain types of businesses over other businesses.
Right.
And in fact, in doing so, it does the import base. It's almost, I think it's hard to say that it's not punishing, because they're being penalized.
And I don't disagree at all with what you're saying. I mean, and I think, you know, let me back up, and I'm not taking up for Speaker Ryan or Congressman Brady. They're trying to play within the rules that they're given to try and get the tax reform they're trying to get. You know, if you sat down and said, okay, this is what we want to do, we want to lower the corporate so we can get the companies to bring their money back on shore, but you got to figure out a way to offset it, because we have to have a dollar for dollar offset. Again, you know, I mentioned the Reagan tax cuts. There was no pay for back then. You know, he would not have been in those. They may have never happened.
Yeah,
you know,
if you've got to have one, you don't unfairly
Right.
discriminate against some maybe less popular group of businesses.
right. No, I don't disagree. Yes, sir.
Two things. One is you talk about effective corporate tax rate.
Yes, sir.
When you put a tax on it, it always causes a distortion, because then people make decisions based on how to avoid tax instead of how to maximize profit.
Right.
So even if people have a lower effective tax rate, they're probably making less than optimal decisions to get themselves there. And then secondly, I mean, basically they're coming up with that in order to be sort of stealth tariff.
Yeah, that's a.
Everyone knows the tariffs are wrong and they cause problems. So instead of saying we're going to put a tariff on, they say, oh, we're going to put it on the back. A whole different thing.
We're going to put a fee rather than a tax.
Exactly.
So.
And then, you know, so now, yeah, I think they're basically just trying to say, you know, they want to be able to say, okay, we're going to put up tariffs so we can get the money back, whatever. Vote how they call it. Nobody else would do it.
But I mean, back to your effective tax rate. I mean, we all do it. I mean, at the end of the year, how many of you take your stuff to Goodwill? You know, we all run to Goodwill on the December the 25th, or not 25th, December the 22nd, you know, and try to get that last minute tax deduction. We all, you know, you make your IRA contribution. You do those things, and we don't think of it as tax planning, but you're reducing for the same purposes. It drives our decision making, just like something like this would drive it on a larger scale. So.
You mentioned this was, I guess, you're thinking of Ryan and the congressman, but as I remember Trump, he just said, let's lower the rates, so more money's in our pocket, and everything will prosper. For some reason, they feel by lowering the rates, we're taking money from them. We're not doing that.
Right.
But they come from a different line of reasoning than the president was coming from.
Right. Well, again, this is, you know, they've got to, under the pay for thing, they got to do they got to figure out a dollar for a dollar of how do I offset that going.
But the layman doesn't say.
No.
Pay for it.
Right.
They're not factoring the dynamics of what we do. I mean, if everyone here was saving $1,000 this year, what are we going to do with it?
Right.
Ryan said we were going to dig a hole.
Right.
He had no idea what we were going to do with it.
Well, yeah, and I go back again to the North Carolina reform, and I worked on some of those pieces with the Senate and the House. When you lower the corporate rate, the hope was that people would hire more people, or they would invest in their business. And then the guy, let's say, you know, you put new floors in your business, in your store to make it look nicer. Somebody had to come put the floors in. I had to buy the floor from somebody, you know, and it trickled through where I was going to hire another employee, who in turn I paid payroll taxes, and he took that money and spent it. You know, this sort of goes in a different direction. You don't have, you know, here we lowered taxes and it generated economic activity. So, yes, sir.
Just to expand on that, this page 4 assumes the economy is static, not
Right.
dynamic.
Correct.
And the growth that you might get from that has been talked about, but it's still not factored into this measure.
Right. No, that's a great comment.
Andy, I have a question.
Yes.
This is kind of a profile of North Carolina retailers that you represent, and what percentage of them are exporters and importers who would be affected by all this?
So let me say this. I should have said this from the beginning. I represent everybody from individual one-person shops all the way to a Walmart. I mean, I've got them everywhere in between, and I do grocery and drug, and I mean, grocery, pharmacy, electronics, you name it. You know, I know, for instance, people like Best Buy, who most of your electronics obviously are imported. Big hit. A company like a Belk, same thing. You know, they import a lot of clothing. But you take a company, you know, I was just sitting with an independent grocery store who, you know, we're going through this, and she's saying all the fruit and some of the stuff, you know, same thing, in the vegetables, you know, trying to figure out how all that plays out. I don't know if that answers your question. I mean, same way, I mean, I've had enough major retailers tell me this is the death knell. This is sort of the down the hill issue, that if that were to happen, you'd see numerous large and small retailers go out of business.
So is this, do you consider this to be one of your key issues for North Carolina retail?
On a federal level, yes. Like I said, I spend most of my time on Jones Street working on other issues, but I've sort of had to get involved in this because if this goes in, you know, we may not exist, a lot of my members. So, yeah, I mean, yeah, up to as big as they get. I mean, people that don't a lot of times engage, this is the one that they're engaging on because they're running the numbers on it. And, you know, they also serve consumers, and they see sort of when you throw that $1,700, they know they don't have $1,700 laying around to spend in their stores. So state level, here's a couple of things we're working on. One is, I think there's a story tonight on CBS News that we participated with on organized retail crime, and I don't know how much it's, which is organized shoplifting gangs that go in with a shopping list of what to steal. And so the felony threshold in North Carolina, you have to steal $1,000. So they will go in, for instance, and steal $950 worth because they know it's not a felony. But they go in, here's the common items I always give. Razor blades, if you want to know why we have the little thing, it's because they're one of the most common stolen items. Batteries, if you want to know why they're at the front of the store, they're one of the most common items. Infant formula, which is $22 to $25 a can, very, very much on the stolen list. Pregnancy test kits, teeth whitening strips. We run a database that's a public-private partnership with law enforcement, and it is amazing what folks do. It's a gang. They basically go in with a shopping list of what to steal. They steal it, and then they resell it either on the internet or on eBay or at the flea market. If you see those items there, they're not legit. And so it costs the state about $30 million a year sales tax. And what our bill does this year is we're after the guy that's, there's a provision that we passed a few years ago. If you steal more than $1,500 in a 90-day period from more than 2 locations, it's a Class H felony. We're taking that up to sort of a kingpin level. If you steal more than $20,000, you go to a Class G felony. That's a huge issue. I have every retailer going nuts about it. Again, there's a story on it tonight. If you want to, it's scary of what they're doing, but if you want to, and more brazen of what they're doing. But I've got a retailer, for instance, down towards the coast, and he gets robbed blind on Simply Southern shirts, Yeti coolers, those sort of things. High dollar volume, high margin. So they get, but if you look at organized retail crime, it'll blow your mind. We go in and tell legislators about this, and they think we're after the kid stealing a pair of sunglasses. We don't really care about that kid. I mean, these are people that are stealing thousands and thousands and thousands of dollars every single day. If they put this to good use, it'd be really good. Unfortunately, they don't. That's a big issue for us. Working on some of the alcohol legislation. Trying to think what else we've been working on. Some workers' comp legislation to further reduce. You know, you've seen for businesses their rates have gone down 10% last year and 14.4% this year, which is, I mentioned Dale Falwell's, Treasurer Falwell's workers' comp reform from 2011. We're finally starting to see the results of that. Some things in tax reform, working on some of those as well. So.
On this, you mentioned Congress is pursue this. Do you have any position? What does the Commerce Department say?
I'll be honest, I have not had conversations yet with Secretary Copeland, but it's probably in due time. I mean, I've talked, we've talked to a number of the members of the congressional delegation. We did a press conference a couple weeks back with Americans for Prosperity, myself, Art Pope was there, Becky was there, Mitch was there, a number of other folks, just trying to bring as much as anything else, because you hear border and you think about the wall. And it sort of goes right over everybody's head. Yeah, change the name. They did a good job with that. So that's, this is, so we're really trying to get to the level. What we're hearing a lot of from folks is a lot of the House members are sort of saying, I'm just sort of following leadership for right now and sort of seeing where this goes. A lot of people are non-committal, but a lot of people off the record are saying, I don't want to do that. Yeah, so.
Mass shoplifting.
Yes.
Do the retailers feel that the legal system poses too much of a risk to them if they happen to confront a suspect? Is that a concern there?
So we're,
in terms of like liability?
yeah, so we're allowed to legally detain a shoplifter currently, under current law.
Yeah, but what's the standard
Right.
for who is a shoplifter?
Right. Well, and it's reasonably believed, and if you've got evidence. But here's the issue is, and we saw this in, it was a Sunglass Hut, Luxottica, and I was talking to them. It went from somebody stealing and putting in their pocket and walking out the door, and most, they're really good. I'm going to tell you one more scam before we leave, which you'll love. But now they're violent. They're violent. The shoplifter has gotten violent and more brazen, and they're trying not to put their employees at risk as much as anything else. So I'll give you, this is my favorite scam that happened in the northeastern part of the state. 3 ladies took a grocery store for about $3,000 on one Sunday. And this is what they did. One lady goes in, she takes 6 of the Smithfield hams and she takes a sticker off of them. She pushes them to the back of the case and covers them up. She walks over to the dairy aisle, hands those 6 stickers to another lady who takes them out and goes to the parking lot. The lady in the parking lot comes back in, comes to the customer service desk and says, we were doing this cancer fundraiser at church and to help raise money for medical bills. And we opened up these 6 hams and they were all rancid. And we had to throw them all away and go buy new hams. And the customer service manager, trying to be good, says, okay, and it's a double your money back guarantee. So those hams are $30 a piece roughly. So they 60 times 6, 360, and they hit about 10 grocery stores up in the Roanoke Rapids area in one day. 3 little old ladies. We're part of a shoplifting gang that were doing that. But they run I-85, they run I-95. They know in Virginia, you have to, the felony threshold is $200. Here's $1,000. So you don't want to shoplift in Virginia, you want to shoplift here, or South Carolina. So we've done some things to sort of maneuver around some of those things. If you use it, one of the ones they do, they use the exit door. They know you can't lock the exit door. Keeps you from going out through security, so they run out the exit door and there's a car waiting for them. The other one that they do that I hate, and I'll quit on you, Donna, 1 second. This is my last one. They'll go in and buy a $19 drill that's on special at a hardware store, Lowe's, Home Depot, name who it is. They make a fake barcode. They copy that barcode for $19. They put the barcode on a $300 drill. They buy the drill for $19. It goes through, gets scanned. The clerk doesn't, it says drill. This is a drill. So they take the sticker off. They return the drill, get a gift card for $300. Sell the gift card to the construction yard, put it on eBay, put it on one of these gift card exchanges, and take the cash over and over and over and over. So, but we all pay for it because it goes, it's almost like this, it goes into the cost of the goods. So.
Andy Ellis with the North Carolina Retail Merchants Association. Thank you.
Thank you very much, Donna. I'm sorry.